Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much, much more. Good morning, Tyler. How are you?
Good morning, Dean. I'm doing well. How are you?
Good. We have a good show today. We're going to be talking about identity theft protection and some of the data breaches that a lot of people here in Wisconsin have been hearing about. And then after that, we're going to talk about preparing for the unexpected in retirement. Seems to be when we look to retire, we've got that line in the sand when we want to retire. Everything's in place, or we hope that it's in place, but unfortunately life happens. And sometimes we have to plan around that. So to get started today, let's talk about the identity protection. A lot of people have heard what's gone on with the Equifax breach. It's very big, very large, but also we're hearing from clients coming into our office that there are a number of local companies that have had data breaches and sending out letters informing people that some of their personal information might have been compromised, and then giving them an offer of a free monitoring service for a year or so. So, Tyler, why don't we bring our listeners up to speed on what happened with the Equifax breach first and what we can do to help out?
Yeah, Dean, and obviously many people have probably heard of the Equifax breach, may not know exactly the details or what happened with it. But in today's day and age, cybersecurity and online fraud, identity theft, it's all a hot topic because many people have dealt with it or they know someone who has had their information hacked and whatnot. But in terms of the Equifax breach, on September 7th, Equifax announced that 145 million people in the U.S. had either Social Security numbers, birth dates, addresses, or driver's license numbers exposed. So that's approximately 44% of all Americans. And in addition to that, about 209,000 people's credit card numbers were also accessed with this Equifax breach. And the interesting thing is that many people don't even know that they were affected, and the reason being is that Equifax actually gets credit reporting information directly from your bank or your credit union without you going directly to Equifax and providing them with that information. And I've taken calls from a number of people just saying that, I wasn't affected by the Equifax breach, but how do I protect my information? When really many people who had their numbers, their Social Security, driver's license, birth dates, and whatnot hacked, they didn't even know about it because, like I said, you don't even have to go to Equifax and provide your information. They can get it directly from your bank or your credit union. So definitely you're going to want to check into that to see, even if you hadn't provided information, even if you haven't heard of Equifax before, you're still going to want to go back and do the necessary steps to check and see if you were affected by any of the breach.
Okay, a couple things too. Tyler said that many people didn't even know they were affected by the Equifax breach. If you go and apply for just homeowners insurance, I believe you go through a credit reporting process. So a lot of people, again, weren't aware that they were part of the breach. Now, there are a couple things when we look at just sheer mathematics. 145 million people were affected by Equifax. However, we're seeing here in Wisconsin a number of smaller companies and investment firms that have said their information has been breached. Some of those smaller situations actually concern me more than the large. And again, it's just purely from a mathematical standpoint. You have more of a chance of getting lost in the numbers of the Equifax breach than you do with a company that might have 20 or 30,000 customers that have been breached. So a couple things that we can do. First of all, some of the very basics. Don't wait until you receive a letter to say that your information might have been compromised. Go out there and look at some of the identity theft software programs, LifeLock, Xander, some of the others. We personally recommend Xander. We like that one. If you want information on that, not personally endorsing it, but we do like the features. you can go to Dave Ramsey's website and you can look at the Xander insurance option that they have. But looking at identity theft, most clients will come into our office and they'll say they're worried about their current savings or checking account or investments. Of course, that's very important, and you want to take all precautions to protect those. But most people don't realize it's the identity theft itself that could happen years down the line. And the identity theft is where the money really adds up to try to restore your identity. Somebody can get your social security number, your date of birth, and your name. They can create false accounts and a false person under your name and rack up absolute tons of debt going forward. So that's one of the reasons you would like to try to plug into some of these identity theft software programs that can help you out. Again, don't wait until that happens. The other thing, too, is we looked at a couple of the letters coming in that our clients had received from anything from Medicare supplement company, or Medicare Advantage company, I should say, and some local banking institutions talking about breaches. And in those letters, they have an offer that the company that received the breach is offering 1 free year of credit reporting so people can monitor and see if anything happens. We caution our clients and our listenership here, take caution with that free offer. And unless there's no strings attached, really scrutinize it. As an example, we see many times that the small print says that if you accept this free offer to monitor your credit for the next year, the company that had the breach is not held responsible. You cannot go back against them with a lawsuit or a class action lawsuit. So we tell people, you know what, spend the money, go out independently, whether it's LifeLock, Xander, or anything else, and get your own and monitor it. That way, if something does happen, you can still be involved with a lawsuit should you need to protect yourself.
Exactly, Dean. And as you mentioned, the Equifax is a data breach, and data breaches are one form of identity theft that's kind of out of your control. But, identity theft can happen to us on a day-to-day basis through a number of different means, whether it be something as simple as a lost or stolen wallet, mail theft. Smartphones is another big one. If you lose your phone, everyone has information, personal information on their phone. A lot of people have different banking apps and account applications on it and stuff like that. So at the very least with that, put some sort of passcode on it. Telephone solicitation and phone scams as well. That one really targets the elderly, and we've had a number of clients who called in just wondering about different phone scams. One going around right now is the IRS phone scam, where someone will call saying they're from the IRS and that if you don't pay a certain amount of money, the local deputy is going to show up at your doorstep, and obviously the IRS will never call to collect debts. But phone scams are another one to watch out for. And then just something as basic as computer and internet security, having the correct antivirus and firewall installed on your computer are steps to take there. And some additional steps to take to protect your identity that we recommend is something as basic as checking credit card transactions and bank account statements at least weekly to monitor for suspicious activity, and use secure passwords and different passwords. Don't use the same password for all your accounts for different types of online logins. And then also maybe two-step authentication, such as a text or email along with your password that gives you a text or email code to log into an account. So it might take an extra step for you to get into your accounts, but it can be necessary to protect against ID theft and different things like that.
Okay, Tyler brought up credit card. Here's another scenario with your credit cards. First of all, many people think it's a compliment when they receive a letter from the credit card company saying their credit limit has just been increased. You've been approved for additional credit. So you might have $15,000, $20,000, $25,000, $30,000 of credit that's available on your credit card. The question I have for most people out there is, do you need that much on there? Okay. In today's world with data breaches, it's probably in your best interest to get a hold of the credit card company and reduce your credit limit. I recommend to people, if they don't use their credit card that often, they just need it for emergency purposes or to put some expenses on that they pay the following month, you might want to ask your credit card company to reduce it all the way down to $5,000. That way, if there is a data breach and somebody compromises your credit card, you have a maximum amount of approximately $5,000 that could be put on there. So having a large credit isn't necessarily good for you going forward if you don't need it. The other thing is too many credit cards. I had one client come in, we went through this process, and I asked her how many credit cards she has, and she said 18. And we looked at all the credit cards, and of course she picked up some credit cards because there's some free offers and so on and so forth. But she said out of the 18, I only use 4. And I said, well, the others are still active. Well, no, they're not because I don't use them. Well, yes, they are. Okay, understand that even though you don't use them, they're still active. So if you want to deactivate a credit card, you need to contact a credit card company to close out and deactivate it. Now, some people will say, well, that's going to hurt my credit. Okay, if you're in your late 50s and 60s and you have your debt under control, maybe your mortgage is paid off, yes, you will probably need to be scrutinized for credit for a vehicle in your retirement. But really, by reducing your credit cards is not going to hurt your credit limit to the point where you probably will not be able to get a loan.
Good point, sir, Dean. One or just two other things that I wanted to touch on in terms of how to protect yourself from identity theft. And you had mentioned it earlier, was Purchase Identity Theft Protection Plan. And like you said, Xander offers one. Most of them are pretty affordable. They can be purchased for around $75 a year for a single person or $145 a year for a married couple. And what these do is they provide instant notifications like a text or email alert when your information is at risk, when it detects your social security number being used, your driver's license number, and other types of personal information. It'll give you an alert right away. So you have that alert right at your fingertips, and you can then go and act on that and try and stop it before the theft even happens. And again, if you do purchase a protection plan, make sure that you have one that's all-encompassing, that it covers all types of ID theft events such as financial fraud, medical ID theft, tax fraud, Social Security, criminal activity, child ID theft is another big one, benefits fraud, employment fraud, and title fraud. So there's a lot of different types of fraud out there. Just make sure that you get one that can protect the whole entire gamut. One other thing, if you do think that your identity has been stolen, you can go to its annualcreditreport.com, and you're entitled to one free credit report per year from each of the 3 major reporting agencies, Equifax, Experian, and TransUnion. You are entitled to one free credit report to see if someone out there is using your name and has opened up a line of credit.
Okay. That's it for the data breach and identity protection. We're going to talk about preparing for the unexpected in retirement. As I said earlier, unfortunately, life happens. Your financial plan isn't always enacted the way you want it to. But before we go any further, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, getting back to preparing for the unexpected in retirement. At Secure Retirement Solutions, Tyler and I, as financial advisors, also our business partner, Kevin Klug, we put together financial plans for anybody who comes through the door. They're complimentary. We do that because we want to see what your financial situation is like. We want you to know what your financial situation is like before you go into retirement. Retirement is very daunting for a lot of people, so we want to make sure we answer those questions. So as an example, somebody might have an expected retirement date of 65 years old. Unfortunately, we get a phone call in their late 50s. They'll say, I lost my job. Okay, so what we need to do then is go back and look at some of these items that we need to tackle now to make sure this person can still afford their retirement going forward. Tyler, what are we going to look at as far as the unexpected when it comes to retirement?
Yeah, Dean, and before I touch on that, everyone hears it all the time in terms of planning for a comfortable retirement. What you have to do is save, and save some more. But to really be comfortable in retirement, you have to have a plan to handle the unexpected events and circumstances that can affect your retirement. And the ones that we'll touch on today include healthcare costs. So right now, that's a very hot topic with health insurance right now in the health insurance industry. Forced early retirement is another one, where a lot of people, whether it be through job termination, an illness, whatever it may be, you're forced into an early retirement. Social Security, there's a lot of unexpected changes and things like that in the Social Security environment. Emotional investing is another one where people don't stick to their plan, and there's always unexpecteds in the market. And then long-term care can be another one that we talk about that's can be very unexpected for people in terms of their retirement.
Okay, so we're going to talk about healthcare costs right now. People don't understand how expensive healthcare really is. And even if you receive subsidies under our current healthcare program, many people still have out-of-pocket expenses that need to be taken care of, whether it's prior to Medicare or after Medicare. So, Tyler, let's take people through some of the costs that we're seeing with medical expenses now.
Yeah, Dean, and this is something that many people don't know. They think that when you reach Medicare age, you can go down to the Social Security Administration and sign up for Medicare Part A, Part B, and you'll be all fine and dandy. But what they don't realize is that, sure, Medicare Part A and Part B cover 60 to 80% of healthcare expenses in retirement, but that gap, you need to then go out and get a Medicare supplement, which would then fill in that gap and cover everything. So that's something that not many people know about, is that you've got to go out and get a supplement to cover that gap when you do file for Medicare. And on average, a married couple spends around $250,000 in total throughout their retirement on healthcare costs. So that number really jumped out to me. And again, that's not from your retirement funds. It can be from Social Security, savings, anything, but total about $250,000 throughout their retirement, which is a huge chunk of money when you really think about it. And really, the best way to prepare for healthcare costs in retirement is to sit down and make sure that you get the right health insurance and Medicare plans in place beforehand, before a big health event happens, and then simply save enough before retirement so you have extra money in case you do have to dip into it for different unexpected healthcare events that arise.
Okay, and the reason that healthcare comes into a conversation so much with us as financial advisors is the way you pull your income when you retire affects how much you're going to pay in healthcare. And what we mean by this is, prior to the Affordable Care Act going in place, things such as pre-existing conditions could be scrutinized and looked at, and really the coverage that you were interested in getting would determine the price of your premiums. But through the Affordable Care Act, which is now in place, even though there's a lot of discussion about repeal and replace and amending, we don't know where it's really going to go at this point. So as we sit here today, the Affordable Care Act is still in place. That means that your premiums are based on income. Pre-existing conditions are all covered, but income is what determines your premiums. So how does that come into play with your financial plan? Well, many times people have IRAs or a 401k. They'll have some cash positions. They might have Roth accounts. And if somebody from the financial industry doesn't give them direction on how to withdraw, you could pay a substantial amount in premiums, or you could reduce your premiums substantially. Here's an example. Prior to the Affordable Care Act, we would recommend Roth accounts be pushed to the tail end of your retirement. Part of the reason is you can best afford to pay taxes early on in your retirement, so you take the accounts like IRAs that are going to be taxable when you withdraw the money. As you get older, your investments typically come down a little bit because you're utilizing them. That's a financial plan. That is very typical. So as you get older, in your 80s and maybe 90s, you now have less money to live off of as far as the total pool of investments. So at that time of your life, to be able to start drawing off of Roth accounts, which are totally tax-free and have been growing tax-free, is a great benefit at that time of your life when you can use them. Also, later in your life, of course, the chances are more likely that you're going to pass away compared to earlier in your retirement. And when you pass away, your Roth accounts will go on to your loved ones and heirs 100% tax-free. So we used to recommend Roths pushed off towards the end of your retirement. Now, many times, we will recommend cash and Roth accounts used at the front end of your retirement, because if you need health insurance, because you're not old enough at 65 to get Medicare, but you might be retired at 58, 59, 60 through 64 years old, what happens is, again, your income determines your premium. If you pull from cash positions and Roth positions, even though you're taking that income, it's reported as zero income when it shows up for your health insurance premiums. So hypothetically, you might want to draw $60,000 a year as a combination between your Social Security and your investments. And what you can do is still get that $63,000 or $65,000, but maybe 20 of that or 30 of that comes from Roth and cash positions. Therefore, your reportable income is only in the 30s. And what that's going to do is reduce your premiums. That's all part of the way the system is set up. So withdrawing from the correct accounts is going to really help with your health insurance premiums. Anything there, Tyler?
Good. Nope. Everything. I think we covered that one there. Just with healthcare costs, it's unexpected, but there's a number of different ways to go about funding that.
Okay. The next one we're going to look at is forced early retirement. We'll put together a financial plan for a client, calls for them to retire when they think they want to retire, when the numbers look good. Again, we get that phone call saying, I lost my job, so we need to go in and take some action, create a new financial plan, look at the investments, make sure they're where they should be based on this person now retiring sooner than expected. But we will tell you this is why we're a big advocate of reducing your expenses when you start to hit your early to mid-50s. Because even though you can plan on things, we will get people coming in, they'll be in their late 50s, and they say, okay, if we stay with our current plan, we'll have our mortgage paid off by the time we're 65 years old. That's fine, but let's see if we can expedite that. Let's see if we can reduce it even more. So you're going to feel a little pain by paying more. But the reason we do that is, unfortunately, if your employer says you're no longer needed in the workforce and you have to retire 2 years early, by reducing your debt is going to help the options that we have available for a comfortable retirement.
Yeah, good points, Dean. And one thing that I wanted to point out was that Voya Financial conducted an early retirement study, and they found that 60% of retirees left their job unexpectedly due to either health issues, job termination, or caring for a spouse or parent. So that's a lot of people. That's over half of the people in the study were forced into an early retirement. And, that can really disrupt a retirement plan, as it can alter when you start drawing Social Security, when you start to withdraw from your investment funds, and obviously it can disrupt your health insurance plan as well. So if you are forced into an early retirement plan, number one, you want to start by putting together a retirement income plan, like you had mentioned, Dean, cutting debt and finding out where the income is going to come from. And then another thing is to explore alternative options like part-time work. If you weren't ready to retire and you got forced into an early retirement, part-time work can help kind of fill that gap, fill that income gap, and allow you to plan a little bit so then when you are retired, you can live a comfortable lifestyle.
Okay, the next one we're going to look at is Social Security. Tyler, you know as well as I do, we talk Social Security a lot in our office. I want our listeners to understand we do not work with the Social Security Administration. We're not employed by them or endorsed by them. However, we talk Social Security a lot. Why? Because it's part of your financial plan. It's part of that fixed income that people use as the basis and many times the foundation for their retirement. So having said that, what we need to do is look at Social Security options. And before we look at some of those options, I do want to say that, I was watching a TV show, and there's a financial professional, and she will constantly tell people, no matter what happens, I don't want you to file Social Security to 70. And of course, and obviously, the longer you wait to draw Social Security, the more money you're going to make on a monthly basis. However, to make a blanket statement like that nobody should take Social Security until they're 70, I believe is wrong. We believe is wrong. And part of the reason is, in the Social Security documents, we'll even say this: Social Security is a personal decision. It's an individual decision. And many times people will have to take Social Security early. And part of the reason is just what we're talking about today. If somebody loses a job before they expect, if they were not to take Social Security and they run their investments down too heavily, it's going to leave them in a pretty bad place at that point of their retirement. So we look at each individual person before determining and recommending when they should look at filing Social Security. So do not accept the fact that somebody says take Social Security at this age and this age only because it's the best thing to do. It's all based on your own personal situation.
Yeah, good points, Dean. And Social Security, this can be a real X factor in retirement because it's probably the first decision that someone has to make in their retirement. And once you start collecting, generally you can't reverse that decision to collect Social Security. And also, I just wanted to point out to our listeners to be aware of the different claiming strategies. One major one that some people don't know about is spousal benefits, where a spouse is eligible for up to 50% of the other spouse's benefit at their full retirement age, even if that spouse who's eligible for that spousal benefit hasn't worked at all. And then there's also widow benefits and divorcee benefits, where those who are widowed or divorced and haven't remarried can claim benefits and based on their deceased spouse or ex-spouse's record as well. So just different strategies to be aware of when it comes to claiming your benefits for Social Security. Okay,
and one of the pitfalls and the thing that somebody doesn't really expect is emotional investing. Let's say you are currently working, people are emotional enough in their investing both when the market is going up and going down. But if you were to lose your job early, it seems like that emotion is kicked in a little bit more. It's no longer on cruise control. But right now, we talk to a lot of people that haven't been in the market, let's say, for the last year or so because they thought it was too high. Well, the same conversation was going on in 2011. So really what you need to do is still take the emotion out of it, look at geopolitical, look at economic situations, and also gut feeling. And I mean that from a client standpoint. If it doesn't feel good for you, do not feel that you need to invest or pull out of the market just because your colleagues at work say that's the right thing to do. So emotional investing, let's look at the facts and go forward there. Now, one of the options I think people have when it comes to taking some of the emotion out of the mix is we do a lot of risk managed investment portfolios. We're very active with those, and what that does is it allows the investor to stay in the market, but it's an actively managed portfolio where we have the ability to sell some positions within the portfolio if the market starts getting a little bit queasy or gives us some uncertainty, and we'll pull back a little bit on what is in the market and move it into a cash position. And we try to do that at a healthy market, so we're basically building cash and taking gains at that point. So if the market does go down, then we can take that cash position and buy in at a low, which is what everybody wants to do, which is buy low and sell high. Okay, unfortunately, most people let their emotions come into play, and they are selling at the wrong time. The market is getting low. They're feeling uncomfortable. They sell at a low, so they sell good positions at a low to buy at a low. Doesn't work.
Exactly. And Dean, like you mentioned, oftentimes investors will make knee-jerk reactions based on the market, see the market doing so well, and they have some recency bias where they hear the word all-time high all the time, and they want to buy in with the market at a high, and then when it gets a little bit queasy, the market goes down, then they sell off at a low because they can't stomach the loss. So really it's about meeting with a qualified advisor and coming up with an investment plan and sticking to it. And just lastly here, one quick study I want to point out is by Dalbar, an investment research company. They did a study of 20-year average annual investment returns from 95 to 2015 and found that the S&P 500 averaged about 8.2% per year versus the average equity investor who averaged about 4.7% per year. So again, that's where the average investor buys and sells at the wrong time. But really, like I said, again, it's with coming up with a plan and then meeting with an advisor, then sticking to that plan. Even when the market gets shaky, through thick and thin, you want to stick to your plan that you came up with.
Okay, folks, hope you enjoyed the show this week. That's all the time we have. See you later, and hope you'll join us again next week.
See you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.